Consider it a challenge before the whole human race.
Can you believe it, my friends? Pretty incredible game yesterday. I hope you all got a chance to watch it. I am exhausted and I've lost my voice, but I'm starting to get it back just in time to bring you another market update. So let's dive into it, shall we? Here we go. All right. So we're going to start out with what to watch for this week because it's going to be important. The BLS jobs report that was supposed to come out last Friday never did. So now they've kicked it forward here to Wednesday. So this is going to be really, really important to see what's happening. Overall, we are seeing a weakness in the jobs market. We're seeing a weakness in the hiring, as well as we are seeing a weakness in job opening and labor turnover. I showed you all that last week over on Instagram. So if you don't follow us, definitely give us a follow because we update that on the daily in our stories and you get 30 seconds worth of information quick so you know what's going on. So that's the BLS jobs report highlighted there in red. The other thing that's going to be really important for Friday is going to be the CPI, the Consumer Price Index, that measures inflation at the consumer level. So let's see what those numbers come out like, and that's going to dictate what's happening here with rates. If this BLS jobs report comes in weak and or mimicking what the ADP report came in last week, then we're going to hopefully see a bettering of the rates. Okay, mortgage-backed securities look like they are primed for a pickup. They've tested this two days in a row, Friday and today, and is holding steady, and we are seeing a positive stochastic crossover here. That's the trend meter, if you will, so we can see that hopefully we're on the right path. So cross your fingers. All right. Something else that's making the rounds, and I want to explain it to you because there's a fair amount of confusion out there. So the fellow on the right there, his name is Scott Bessent. He is the Treasury Secretary. And one of the things that he is proposing is to, deregulate the banks. What does that really mean? Well, it means that after the 2008 crash, there was regulations put on the banks about what they could invest in or what they could buy, etc., to make sure that they don't run out of money, make sure there's no run on banks and horrible things happen to our financial institutions, right? So all good ideas and good things. So what he's talking about now is what we have is old and outdated. He wants to modernize the regulations in order to be able to have things work in a way that it supports economic growth. He wants to improve the liquidity in the marketplace, which is great. And he wants to strengthen the U.S. Treasuries market. As I mentioned there, these are all technically true, but there's a reality check here. So we are, as a nation, collecting a debt of about $2 trillion per year. That's piling on top of our current debt load, our current credit card bill of $35 trillion. That's 12 zeros, just in case we start to lose sight of all this stuff. There's constant treasury auctions happening, meaning that they are still selling that debt. They're printing money, if you will, and someone has to invest in that. And the interest expense is very, very high. So what he's doing is he's saying, okay, if I can loosen up the regulations, have big giant banks like your Chase or your B of A that just have pools and pools of liquidity, trillions of dollars in deposits, to be able to have those folks buy the treasuries. It pumps money into the treasuries, brings down the debt, and it's almost working like a quantitative easing. And if you remember, when there's quantitative easing, mortgage rates go down. So if this works, rates will trend lower as we move forward into 26 and 27. We'll get some relief as far as housing goes, although if rates do dip in that 5-something range, we're going to probably see a lot of more buyers come into the market, which will drive housing prices up. So it's a real delicate dance, isn't it? And then the refinance cycle will arrive here sooner so folks can get some relief and lower those rates to lower those payments. If it fails, well, there's going to be a sudden rate of spike of rates happening. We're going to see a lot of stress on banks and financial institutions, and it's going to affect the United States credit rating overall. So this is kind of a risky game to play, but we're going to have to just watch and see what happens with it. Either way, I wanted to make sure that you are in the know and know that it's happening. Okay. Rates. Let's talk about that. Rather flat. 616 last week, 615 this week. Again, not a whole lot that's happening that is groundbreaking. And as I mentioned to all of our refinance clients, you need to have your hand on the trigger and you need to have a target rate. And the minute that target rate happens, then we can execute for you. Okay. So if you don't have that set up yet with your loan officer or with us, pick up the phone and give them a call, or give me a call, and let's have that target rate conversation. Remember, these rates are for folks with 780 credit scores. These ones are about purchase loans, 25% down, and they're national averages. So yours might be a little bit different. Okay. All right. So as always, subscribe, like, comment, share so everybody can be as smart as you are. I hope you're all recovering after yesterday. I know my voice can use a break here today, so I'm going to try to keep it on the down low. Okay? Take good care. See you next week.